We have, as I mentioned, three terrific panelists this afternoon. I'm going to go in order. Closest to me is Mike Musa. Mike was a Chicago faculty member from 1976 to 1991. He also served as economic counselor and director of the Department of Research at the International Monetary Fund for 10 years. He also served under President Reagan on the U.S. Council of Economic Advisors. He now serves as senior fellow at the Peterson Institute of International Economics. Please join me in welcoming Mike Musa.
Well, thank you very much, Ted. It's a pleasure once again to return to this podium. Last year's forecast was not a total success, but not a total disaster either, so I'm not too much embarrassed. Indeed, the economy was pretty much putzing along on the edge of recession for most of 2008 until roughly mid-September when we had the collapse of Lehman Brothers and the near failure of AIG, which was rapidly followed thereafter by a freezing up of global credit markets, a sharp decline in world commodity prices and in equity prices, again all around the world. And as this was happening, incoming economic data was increasingly showing a turn towards recession in most other industrial countries, the beginning of significant weakening in the U.S. economy after mid-year, and a slowing of growth in many key emerging market countries. There is now no doubt that the U.S. economy is in a steep recession. And the world economy as a whole will undoubtedly experience a recession as well. Both of these recessions are likely to be significantly more severe than the recession with which we began the present decade, where the decline in U.S. GDP, peak to trough, was barely 0.2%. With recovery expected in the second half of next year, year-over-year growth for the U.S. economy in 2009 is forecast at minus 0.8%. This is well below the plus 0.8% that we saw in 2001. Recovery, once it starts, is expected to proceed at about a 4% annual rate, meaningfully below the 5 to 8% rate that have characterized the recoveries from all previous relatively deep recessions in the post-war era. The unemployment rate in the United States, which will be announced again on Friday, is expected to rise above 7.5%, probably topping 8% by late next year. And the subsequent decline in unemployment is likely to be gradual, with substantial margins of slack remaining in the U.S. economy through 2010 and into 2011. With the sharp decline in world commodity prices, especially oil prices, since July, headline inflation rates have already fallen sharply on a 12-month basis and are likely to moderate further in the months ahead. Core inflation rates have declined less, but further moderation should be expected. I am anticipating the U.S. overall CPI will rise 1.5% next year, with the core CPI up about 2%. In these circumstances, macroeconomic policy will remain oriented toward restoring orderly conditions in credit markets and providing sufficient stimulus to assure that the recession is not unduly deep or prolonged and that recovery is sufficiently robust. Unwinding the massive government interventions undertaken to combat the present crisis and containing the overheating risks and moral hazards likely to be engendered by these actions are challenges that will be put off at least until the middle of 2010 and beyond. The seizing up of global credit markets that began in mid-September and October posed an unprecedented and dire threat to the functioning both of the financial system and of the real economy. Businesses of all sizes and descriptions rely on the ready availability and circulation of short-term credit to conduct a myriad of transactions that are essential to their normal functioning. When the great wheel of circulation, as Adam Smith describes it, grinds to a halt, normal business activity tends to grind to a halt as well. Policy authorities all around the world reacted to this threat on a scale and speed that far surpasses actions in any earlier financial crisis. Central banks have injected literally trillions of dollars of liquidity into interbank and short-term credit markets, with the Federal Reserve expanding its net credit to banks and other private borrowers other than the U.S. Treasury from virtually zero 15 months ago to over $1.5 trillion today, and that figure is going to go up at least another $500 billion to $1 trillion before we're done. Deposit insurance coverage has been expanded massively, and official guarantees have been extended for interbank credits. Governments have injected large amounts of capital to ensure the solvency of major financial institutions to the extent that they have now virtually assured that there will be no major failures that involve private sector losses beyond those sustained by common shareholders. With all of the massive government intervention, conditions in world credit markets have calmed down, although they have not yet returned to normal. Equity markets, which have experienced large sell-offs worldwide, remain highly turbulent. The key assumption underlying the present economic forecast for the U.S. and for the world is that with the aid of continued policy activism, credit markets will not return to the extreme turbulence of September, October, but will rather continue to work back gradually toward more normal operation over coming months. Under this assumption, it is reasonable to expect the present U.S. recession will look broadly similar to other post-war U.S. recessions, where the average peak-to-trough decline measured in GDP terms was 2%. If extreme credit market turbulence were to return on any kind of sustained basis, economic prospects would be considerably bleaker, probably involving a decline in real GDP greater than the 3.7% fall recorded in the deepest of the post-war recessions. Barring this risk, insight into the probable scope of the current recession may be gleaned by considering its similarities and its differences with the 10 earlier post-war recessions. Let me turn then to the four main components of GDP. First, consumption spending. In the average recession, consumption spending in total sometimes goes up, sometimes goes down. In this recession, I expect we will see the largest decline in real consumption spending of any post-war recession. 2.5% drop between the middle of 2008 and the first quarter of next year, 2% through the middle of next year. Why are we seeing the large drop in consumption? Household wealth is falling under the impact of declining house prices. Equity values are declining. Employment is stagnating or going down. The unemployment rate is going up. Real household incomes from those sources are not advancing very rapidly. On the other hand, we have seen a major step down in world oil prices, worth roughly two-thirds of what we saw go up earlier in the year, and that will provide an important benefit in terms of the real value of consumer incomes. Where will consumption spending decline? Well, not in services. It never falls in the area of services, not in 10 recessions. But it will fall very sharply in durables, especially automobiles and light trucks, and in non-durables. Now, there we have some good news. In the categories of consumer spending where we'll see the sharp declines, about 25% of it comes from imports rather than domestic producers. And I'll return to that in a couple of minutes. So we are certainly looking at a sharp, very sharp slowing of consumption spending, deeper than in earlier recessions. Private investment is usually the main driver of recession. And in the category of private investment, the thing that matters most in virtually every recession is inventory investment. Inventory investment declines, accounting for, on average, more than 75% of the decline in real GDP, often accounting for more than 100% of the decline in real GDP in a recession. Not this time. Inventories have been kept quite lean, and as of the middle of this year, inventory investment was already running at minus $50 billion per year. So we'll have a further decline in inventory investment, but it won't make as big a contribution to the present recession as it has to many previous recessions. Business investment in equipment and software started declining in the first quarter of this year and it's going to continue to fall through the recession, and we'll see quite a steep decline in that category of investment. Business investment in non-residential structures has continued to expand through the third quarter of 2008. It is in for a major tumble from a roughly 3% of GDP, probably down by at least a percentage point. But given the relatively long lives of investments in this category, that contraction will probably be spread out across 2009 and most of 2010. So the direct impact over the next 3 to 4 quarters will be muted by that consequence. The result will be that with inventory investment not making such a big contribution, overall gross private domestic investment will make a moderate-sized negative contribution to the recession. Government spending, well, without support from the federal government, state and local governments would at this stage already be cutting back very severely on their spending on capital goods projects and on their other spending as well. However, I expect that the fiscal stimulus package to be passed by the new administration and Congress will involve a substantial amount of support for state and local governments, which will enable them to keep their expenditure growing, both for general services provided by those governments and also in the critical area of infrastructure investment by state and local governments. So overall, government spending will probably contribute 2.5% to 3% to the growth of GDP at an annual rate over the next year. That brings us finally to net exports. Net exports have been the great saving grace for the U.S. economy over the past 2.5 years. Our net export deficit in real terms peaked at the end of 2005 at minus $640 billion real dollars. It subsequently has shrunk by $280 billion real dollars, more than offsetting the massive decline in residential investment. Now, what should we expect going forward? Well, as far as residential investment is concerned, we've already shrunk it more than 40% from the peak, and so most of that is probably behind us. Similarly, with real net exports, most of the gains that we've had from that category, which have offset the decline in residential investment, most of that is probably behind us as well. And what we're likely to see over the next year is real residential investment will fall moderately further, and that will be offset by a moderate further improvement in U.S. real net exports. Not because U.S. exports will continue to grow. They will stagnate as the rest of the world economy goes into recession. But as I mentioned earlier, our imports are likely to be shrinking rather than expanding as U.S. consumers cut back. So when you add it all together, it looks like, for fortuitous reasons, we're in for a recession that is of about average depth, measured from the middle of 2008 to the middle of 2009. It will look a little different than past recessions in that consumption spending will decline much more so than is normally the case, but we'll get some benefit because inventories are in reasonably good shape going into the recession. How will we come out? Well, Victor Zarnowitz pointed this out to me 25 years ago. The regularity in the United States and around the world is steep recessions are followed by steep recoveries, right? You go down fast, you tend to come back fast. This time we're going down relatively fast. We will be slowed on the upside because consumers will still be anxious to improve their savings ratios, and we have the problem with investment in non-residential structures. So rather than 5 to 8%, I think 4% is a reasonable guess as to the likely pace of recovery coming back once the recession ends. What about worries down the road? I noted that we've had really massive policy interventions to stem the financial crisis and limit its negative impact on the real economy. In the last recession, we also had quite large government intervention, and probably the Federal Reserve kept things too easy for too long in 2004 and 2005. That problem is going to be much worse this time around. Not only have we had the traditional easing of monetary policy. We've had massive quantitative injections of liquidity and of capital by central banks and treasuries. Much of that will need to be unwound at some point, not in 2009 and probably not in 2010, but it will need to be unwound at some point. And we have very little experience unwinding interventions of that magnitude. So that's a challenge that will need to be confronted as we look to 2011 and 2012.